PepsiCo out with quarterly results a short time ago. The company reporting an adjusted $2.09 a share, beating the $1.96 estimate. Revenue rose 10.4% to $22.32 billion, driven by strong snack demand. Company raised its sales outlook for the year. For more on the numbers and a first on CNBC interview, let's bring in Hugh Johnston. He's vice chairman and chief financial officer at PepsiCo, serves on our CNBC Global CFO Council. I was going to start. Good to see you, Hugh. Thanks for the Doritos and all that stuff. You never forget me. Thank you. But I was going to start with, it reminds me of when banks interest rates go up. They love raising the prime. They never cut the prime. You probably were able to raise some prices. Now inflation's coming down. Are you sticking with those price increases? Is that helping the results? But then I looked at your organic revenue growth, and it doesn't seem to be based on necessarily on just higher prices. I mean, you're up on selling more units, I think.
Yeah, that's right. And good morning, Joe and Kelly. Listen, our pricing was up, but at the same time, our commodity costs are still up. One of the things to keep in mind is commodities for us, we forward buy about 9 months. So it takes a little while for lower cost to actually work its way in. So I think what's most encouraging to us is the growth was very strong and very, very broad-based. Our North American business grew 11. Our international business grew 15. Beverages grew 11. Snacks grew 15. So certainly a good top-line story. But maybe even more encouraging is the strong margin improvement. And as I mentioned, our pricing and our commodities were basically in line with each other in terms of the rate increase. All the productivity investments that we've been making over the last couple of years are really starting to pay off now. And I think you're going to see a pivot for us toward more margin improvement as those productivity programs not only pay out this year, but pay out over the next 5 to 7 years.
Could you, I mean, you would, if prices come down, will you take back any of the increases? Hugh, have you ever done, has a company ever done that in history? If you do see commodity prices come down, would you add any chips back to the bag?
We've added chips back to the bag in the past plenty of times, so it's not so much a question of that.
It's not good for me.
Well, Joe, we need you. And by the way, we'd like to work on your beverage choice as well. I like the fact that you drink cola. I just think you're drinking the wrong one. You might want to come over to the blue team because I think we got a better product.
I'm drinking the high test now. I used to think you're wasting calories to do that, but I don't know. The sweeteners don't taste as good now. I don't know. Are any of them totally safe? I'm back to thinking. That I like is sugar natural? Natural.
Listen, we think the high test product is great. The low calorie and 0 calorie products are great. So, but back to your question. Keep in mind, commodities for us right now, we don't think they're actually going to be going down in price. We think the rate of inflation is going to be reducing, but we don't see the basket of commodities going negative anytime soon. So we're going to continue to need to take pricing, just probably not at the levels we've seen in the recent past. And that's why we're doing more of this pivot to productivity, to drive margins through productivity. And we've been pretty successful at it.
That is a really good point, Hugh. Because when politicians take credit for inflation being much lower, the prices they're just rising. This rise we've seen for the past 2.5 years, those are still there. It's just now they're only growing at 3%. So the prices, will they ever really, I don't see them ever coming down to where they were.
I'd be surprised, frankly. And our plans assume we're going to continue to see inflation, just lower rate of inflation.
Yeah, which makes it hard. Just explain to me the investments you've made into productivity and how that helps. So it's on the cost side of things in terms of labor or in terms of logistics or in terms of how you stock shelves, or how does that work?
You got it. It's actually all of those things. I'd put it into 3 big buckets. Number one is automation, right? Especially given the challenges just with getting labor in the U.S., we've been investing more and more in automation, and it's making the labor that we have more productive, and obviously that lowers costs. Now, there's a capital cost up front, and we've incurred those capital costs, but now we're kind of getting the benefit of all that. The second one is making the company much more digital, and by virtue of doing that, you actually get more done with the same or fewer numbers of office workers, and you make your people more productive and more insightful at the shelf as well. And then the last one is we've got a global business services operation where We're standardizing a lot of the ways that we do work inside the company. And as a result of that standardization, we can do it more quickly, more efficiently, and at lower cost. All of that stuff is driving real margin improvement in the company, and I think that's something that's going to sustain for some period of time.
Hugh, real quickly, it's Kelly here. It does look like your snacks business has some incredible momentum right now. I mean, I'm looking at analyst notes. They're talking about sales up 13.5%. You know, industry publications are saying it's Lay's, Doritos, Cheetos, Ruffles. Again, double-digit percentage revenue growth here in an environment where most consumers are trading down to private label. Why the kind of dramatic acceleration? What's that all about? Why these brands? What's going on here?
Yeah, I think it's a combination of a couple things, Kelly. Number one, we continue to expand distribution. While we may feel like we're everywhere, we're really not. We still have lots of opportunities to continue to grow. Number two is people start to do more outside the home, whether it's for us convenience stores or whether it's restaurants and colleges and universities and offices as people go back. We tend to have a stronger business there than most of the other food and beverage companies just by virtue of the reach that we have in our system. And as a result, that's sort of a tailwind for the Frito-Lay business as well. And then in addition to that, it's the investments that we've made in innovation. Sorry we missed you this morning, Kelly. We got Joe with some of the new products, the BLT Lays and the... Yeah,
it's all good.
They're all great products.
You got to send a couple over there. She's got, you don't let them eat that.
No, we do. They eat all that stuff. Are you kidding? Anything, yeah.
We love to get them to you. So, and remember, these are great, simple luxuries, right? Whereas when consumers are feeling stressed and they may have to, they cut back on personal technology and cars. This is the affordable luxury you can have. And as a result of that, they're doing it. And frankly, they like the products. I mean, what's a potato chip, right? It's basically potato, salt, and oil. What's a Frito? Corn, salt, and oil. These are simple, great tasting products. Real food, delicious.
Yeah.